This presentation is intended to help individuals understand income tax concepts using a uniquely created big picture of income tax. It is not intended as a reference for filing your tax return. It is designed to show how the various tax components fit together and their general effect on your final tax liability when you file your tax return. Before we start on the integrated big picture of tax, let us quickly view the very basic tax return process. We start at the top with a taxpayer reporting gross income from his job and all other sources. During the year, you would have paid taxes on your income in two ways. If you were employed, then your employer withheld tax from your pay and sent it to the IRS. If the income was from other sources than a job, then you may have made 4 estimated tax payments to the IRS during the year. To start the income tax calculations, you first reduce your gross income by the allowed work-related expenses, called deductions. The income is further reduced by any exemptions you can claim, like for a dependent child. The remaining income balance becomes your taxable income for the year. The next step is to calculate tax on this taxable income using the applicable tax brackets and tax rates. The tax is then reduced by non-refundable and refundable credits. This gives the amount of income tax you should pay for the year. However, we now have to correct this tax amount by the tax you have already paid during the year, which is the tax withheld by employer as in W-2 form, and also by any estimated tax payments you may have paid during the year. The final balance may be a refund or notice for payment. This view is the big picture, or an integrated view of the income tax process. The light blue colors show the 3 different types of income: the taxed at source income, the non-taxed at source income, and capital gains. The tax withheld by the employer or payer, and the 4 estimated tax payments you paid during the year, become your federal tax payments, and is adjusted against tax calculated in your tax return. Income from short-term capital gains is combined with the taxed and not taxed at source incomes for tax calculation at your tax rates. If your total income including long-term capital gains is lower than the 25% bracket, then you do not pay tax on long-term capital gains. Long-term capital gains are taxed at the special tax rate of 15%. However, if the net taxable income amount is below the 25% bracket amounts, then use the alternative path for capital gains tax calculation. You can reduce your income by any accumulated capital losses to a limit is $3,000 per year. Any excess losses are carried over 2 future years. Your income is then reduced by deductions like our expenses for work and exemptions, like personal or dependent exemptions, to arrive at your taxable income. Your taxable income is then taxed at the applicable tax rates, depending on your filing status. For example, single, married filing together, or head of household. The tax brackets shown here also show you that various tax rates are applied to the part of your income that falls within the tax bracket range. The tax is then reduced by any eligible non-refundable tax credits and refundable tax credits. This tax total is now reduced by tax you have paid during the year as reported on your W-2 federal tax withheld form, and any estimated tax you paid during the year. Taxpayer also pays towards Social Security and Medicare. The final result will determine if you receive a refund or a notice for payment.